Good afternoon, participants. This is Dr. K. Vinodha Devi from Department of Economics. Today we will be handling a few concepts from business economics subject, which will be helpful for your NET exam. Okay. Now what you're seeing in the screen is the syllabus of business economics, the new syllabus. So first we will start with the concept of business economics, the meaning and scope. The next thing given in your syllabus is the objectives of business economics. So we will briefly see what are the objectives, because if you are reading only, you can attend the questions from that part. Okay. So objectives of business firms are there, and the third important concept is consumer behavior, which includes utility analysis and indifference curve analysis. And the fourth concept, important concept, which is there in your syllabus, is the demand analysis. So in demand analysis, we will just see what is law of demand, elasticity of demand, forecasting, all those things. And the next one is production function. In that you will see the law of variable proportion and the law of return. And the next one is theory of cost. So short and long run cost curves, they are very important from a net exam point of view. So we will see that. And very important thing we are going to discuss today, the concept is the market structure. Usually we will be little confused with this concept. So we will see it little elaborately. And the last one is pricing strategy, which I'm not going to touch because you will study the same in your marketing subject also. So if we are able to cover this much, that will be a very big thing. It's very difficult to cover the entire 7 topic within 2 hours, but still we will try to do our best. I will start with the concept. So before getting into the concept, one thing I want to suggest you is like to attend the questions from economics, right? So you don't want to know all the advanced things. If you are very strong in your fundamentals, then it will be easy for you to attend the questions. I just gone through the questions, previous year question papers. So all the questions now, if you are very strong, understood the concept, then you can easily answer. So my focus today will be on the fundamentals of this concepts, because without that, you cannot understand the advanced things. So we will just get into the introduction part of this business economics. This is all what business economics is all about. Business economics is the application of economic theory and methodology to business decision making. So when it comes to economics, it includes a lot of theories, models, econometric tools. So how business economics is different from the normal subject economics is we have selectively taken few theories, few models, which is going to support the decision-making process of business firms. So the application of economic theory and methodology is business economics. So the next topic I have seen in your syllabus is the nature of business economics. From this area also, there were a lot of questions. Okay, so the main thing you have to focus is business economics. The nature of the basic nature of business economics is it is both positive and normative in nature. So how this positive is different from normative? So positive means example of this positive science subject, physics, chemistry, all those things falls under this positive science. And management, commerce, economics, all those things mostly falls under this normative science subject. So what is the difference between this is positive means it includes only the cause and effect. They studies only the cause and effect. So what is cause and effect? If I'm doing this, this will be the effect. If I'm combining these two elements, it will bring this. So with that, positive science will stop. It won't judge whether it is right or wrong, whether we have to do it, how to improve it, whether to implement it. If we are implementing, in what way we have to implement, what will be the result. So it won't talk about anything, okay, all these factors. Positive science will never touch this area. But in management, commerce, economics, usually we will discuss the consequences. We will judge based on the cause and effect. For example, when price increases, demand decreases, whether to increase the price. If we are increasing price, how much demand will be declined? So in what way it is going to affect the business? In short run, sometimes it will be, it won't be good for the firm, but in long run it will be helpful to increase your sales, to get a name, to compete with your competitors. So in that way it will be very helpful. So simply if you are studying the relationship between price and demand, then it is what positive sides. But based on that, you are making decision, right? So it is a normative science. So how it is different from positive sciences? It is subjective in nature, which includes your value judgment also. So this you have to keep in mind, because one of the question I have seen in your previous year question paper is they have asked business economics is a which economic studies the cause and effect relationship. Since you are a student of business economics, immediately the answer is what? Business economics. But that is a wrong answer. To confuse you only, they are asking. Cause and effect relationship is a positive science. If value judgment is made based on that cause and effect, then only it is what? Business economics. So this point you have to keep in mind, this area. So the next topic we have seen in the syllabus is the scope and importance of business economics. Scope and importance means where you can use the concepts which you have studied. Okay, so there are 5 important areas identified where you can easily apply the concepts which you have studied in economics subject. The first area where we can use the economic concept is what? Demand analysis forecasting. If you see the subject itself from the second unit after the introduction part, we will be starting with what? Demand analysis. What is the purpose of applying the models, theories in demand analysis? There are 2 reasons. Actually, it will be very helpful for making business decision. Thing is, for example, 2 areas are there. Okay, so the first area in demand analysis is what? Predicting the demand. First thing before starting a business only, you have to check whether there is a demand for your product or not. Based on that only you can arrange finance, you can estimate the cost, you can go for production, you can fix the price. So everything, all the other decisions what you are going to make in the next stage is based on what? Forecasting the demand, at what price they will demand your product. So the pricing strategy, fixing prices, everything is based on what? The prediction of demand. So that is not the only area where you can apply the concept you have studied in demand. Another important area as a manager, what you have to do is you must be able to manipulate the demand. What is this manipulating demand? For example, during COVID period, we know the demand for the product will be less, right? So that is the opinion of a common man. But as a manager,
Hello, hello,
yes.
hello, ma'am.
Hello, am I audible?
Ma'am, little more voice is required, ma'am.
Okay, sir.
Increase your volume, ma'am.
Okay,
Voice
okay.
is low. Voice is low, ma'am. Otherwise, good only. Yeah.
Okay. I will just increase the volume. Okay. But please tell me whether I'm audible or not. Okay.
Yeah.
Now it is fine, sir. This voice.
Yes, ma'am. This is enough, ma'am. Enough.
Okay, sir.
Okay, ma'am. Thank you.
So after predicting the demand, next thing you have to focus is manipulating the demand. What is manipulating? For example, we all know during COVID period, the demand of the product will be less. So this is the opinion of a what? Common man. But a manager must able to increase the demand. That is, after estimating, you should do something to increase the demand. So what has to be done? So that analysis also you have to make. You have that concepts also there under this demand analysis. So in 2 ways, the concepts you have studied under demand analysis is going to help you. One is to predict the demand, and the next thing is to manipulate the demand, increase or decrease the demand, okay, based on the environment, business environment. So after estimating the demand, the next stage will be, we will be going for production process. If there is a demand for 100 unit, then you have to produce 100 unit of product. Then you have to arrange what the raw material factors of production. So whether you are going for capital intensive technique or else you are going for labor intensive technique. So all those things you have to decide. So what based on what you will decide? Based on the marginal cost of the factors of production, how much I have to pay to labor, how much I have to pay to capital. So all these things will come under what? This cost analysis and production analysis. Cost analysis means mostly based on marginal cost. Based on that only you will decide whether you are going to employ more labor or capital. So once that is done, so what is the relationship between input and output? How much input I have to give to produce this much of output? So that concept you will study under what? Production analysis. So first you are estimating the demand and you are deciding which factors you are going to use based on marginal cost, average cost concept. After deciding that, you are going to study how much input is required to produce the output. And after producing, the next major decision is what? Pricing decision. You have to fix price for the produced commodity. So pricing decision, how you will make. So again, for that also the economic concepts will be very helpful. So we will see that how pricing decision can be made. That mostly the price output determination, the market structure chapter, it deals with this. Because all the market structure you will be studying about the price output determination. If your product firm belongs to perfect competition, so then you cannot increase, you cannot fix high price. In a monopolistic competition, always you have to check what will be the price of competitor. Based on that only you can make pricing decision. Oligopoly competition, there will be cutthroat competition. Okay, so the rival will be very active. If you are increasing the price, definitely it will affect your business. So pricing decision policies, to make pricing decision policies also, this economic concepts will be very helpful. Once the pricing decision is made, then you will start to earn profit. So how to manage the profit? Once these profits started to accumulate, then it will become capital. So how you are going to invest that capital? So investment decisions, all these things come under what? This business economics subject. So these are the 5 areas where you can use the economic concept, where you can apply the concepts you have studied. Okay, so this is the scope of business economics. So 2 questions I have given from your previous year question paper. So the first question is, which kind of economics explains the phenomena of cause and effect relationship? So that is the first question. So immediately the answer will be, you will be choosing the answer normative, but actual answer is what? Positive. So the economics which explains cause and effect relationship is positive. If it includes value judgment, then it is normative science. What is the next question? Business economics is a subject which studies what? So the first option is studies economic relationship, studies economic activities at the aggregate level, deals with the tools of economics used for decision making in business, studies optimum allocation of limited resources. Usually in net exam, the main problem is all the answers looks correct. So we never know what will be the right answer. But one answer will be exactly suiting for that question. So that we have to identify. So definitely economics studies the relationship, studies economic activity at aggregate level. Normally it is not business economics, it is macroeconomics. And the third option deals with the tools of economics used for decision making in business. So this option will be exactly matching for the question. So C is the right answer for the second question. Okay. So if you know the fundamental introduction part of business economics, then you can attempt these 2 questions. So little confusing question will be, but it will be simple if you know the concept thoroughly. So we will be going to the next concept, utility analysis. Actually, utility analysis is a part of demand analysis. It is a beginning point of what? Demand analysis. In what way it is connected to demand analysis means usually why a person will demand. Economics is all about studying the basics, fundamentals strong. Okay, from economics only, commerce, management, all those things came. So they are advanced subject. This is the fundamental. So you have to be very strong in this. So to shine in the what commerce and management. Okay, so what is utility analysis? It is a part of demand analysis. Why you have to actually study this utility analysis? Because we are dealing with consumer. So why he is only demanding our product? So you should know the behavior pattern of consumer, why he is consuming your product, when he will stop consuming your product, how much unit he will purchase, at what price he will purchase. So understand all these things. You should know the utility analysis. It will be supporting you to make a decision in that area. Okay. So what is utility? Want satisfied in nature, that is utility. Because why he is buying the product, paying that much price, it is because it is satisfying his need, that is the reason. So why it is important, we are analyzing the utility maximization behavior of the consumer. Okay, so why we have to analyze that as a firm, as a manager, why you need to analyze that? Because if the utility utility is maximum, then he will buy your product. If some other product is giving him maximum utility, then he will move to that product. Okay, so analyzing the utility maximization behavior is very important in business decision making, to predict your demand, to manipulate your demand. If you are adjusting his utility maximization level, then you can adjust the demand. Okay, for that reason only we are studying this utility analysis. So in utility analysis, if you want to study that, there are two approaches. In two ways you can study. One is cardinal utility analysis. The second one is ordinal utility analysis. So these are two different approaches to study what? Utility analysis. In approach is different from tools. Okay, so in cardinal utility analysis, as a business person, actually you have to measure the utility level to make decision. You cannot generally say if the price is high, the demand will come down. So you have to study to what extent, what I can do. So if you want to make a proper decision, then you must be you have to quantify that, you have to measure that. Okay, so to measure the cardinal utility, there is a concept called what? Utils. We will be measure in terms of utils. How many utils he derived from the consumption of that particular unit. And in our ordinal utility analysis, to measure the utility, we are using a tool, because it is not measurable according to that concept. So we are using a tool called indifference curve. So indifference curve is a tool used in ordinal utility analysis to measure the utility level of the consumer. So approach is different from what tool. These two are approaches, and we are using util tool to measure the utility level under cardinal utility analysis, and indifference curve under ordinal utility analysis to measure the utility level of the consumer. So this is the introduction of what? Utility analysis. So to understand it thoroughly, so you should know what are the properties of this utility. So we all know these are the basic. I will just go through it fast. Utility is subjective, which means you cannot measure. It will change from person to person. You cannot exactly say that what it is. Okay, so that is utility is subjective. Utility is relative. So a person, like it differs from time and place. So, for example, you would have studied with the example of water. Okay, when you are thirsty, when you are drinking water, the utility level will be different. In other time, it will be different. So, it changes from time to time, place to place. So, this is relative. Utility is not essentially useful. It has no connection with the moral values, all those things. Because the example is the harmful product, liquor, cigarette, all those things falls under that category. So that will also give satisfaction for the alcoholic person. Okay, it has no moral standard. So these are the basic properties of water, this utility analysis. So when we are trying to measure it, so we have to know how to measure it. Okay, so for that, three concepts will be supportive. The first one is initial utility. The utility you derive from the first unit, because from there only we will start up. So that is initial utility, total utility. If you are consuming 5 unit, what is the total utility you derive from all 5 units? So that is total utility. Utility is additive. That is one of the property of water. Utility analysis. So you can add in first unit, I have got this much of utils. From the second unit, I got this much. So you can add it. Then marginal utility. Marginal utility concept is very important throughout the subject, business economics subject. The major focus will be on this marginal concept. In this chapter, you will study as marginal utility. In the cost chapter, you will study as marginal cost. And in the production chapter, you will study as marginal productivity. In perfect competition, it is marginal cost and marginal revenue curve. So all these marginal curves are very important. Suppose if a question is asked, which is a decision making concept in business economics, whether it is average cost, average revenue, total cost, total revenue, marginal cost or marginal revenue, the answer is marginal cost, marginal revenue concept. Always marginal cost is the decision making concept. So we will study start with marginal utility concept. Marginal utility is nothing but the additional utility derived from the consumption of one more unit of the given commodity. So we all know, we will never forget what is the meaning of marginal unit, right? It is an additional unit derived from unit of utility derived from the consumption of additional unit of product, that is marginal utility. Why it is a decision making concept? Whether I have to consume one more unit or not. That decision I will make based on this utility level. So if it is not going to give me more utility, then I won't consume that product. So I won't pay more price. Then what you have to do, if your product is not giving more utility for a consumer, marginal utility for a consumer, at that point you have to reduce the price of the commodity. So such kind of decision is made based on what? The marginal utility derived from the additional consumption. So for pricing, fixing price, so for increasing the sales, everything you have to calculate the marginal concept. That's why we are calling this as a decision making concept. Okay. So to measure, you need to know what is the initial utility. In the end, you will be calculating obviously what is total utility, and marginal utility you cannot ignore in business economics subject. And from where more questions will come means the questions will be more on the relationship between this utility concept. Okay, how marginal utility is related to total utility. Here we won't study about the average concept. There are three concepts: the total concept, average concept, and marginal concept. So in utility analysis there is no average concept. So you will be studying the relationship between what? The marginal utility and total utility. So what is the relationship? We are going to start with the initial utility concept. From the first unit, what is the utility level? So it will be maximum. When you are consuming the first unit of the product, definitely the utility level will be very high. But marginal utility keep on declining from the initial utility. Okay, from the in the first consumption, the utility level will be very high. In the second unit, comparatively, relatively, it will be less. In the third unit, it will be less. If you are consuming the 10th, 7th unit, it will be 0. 8th and 9th, it will be negative. Okay, keep on declining. So there are three possibilities for marginal utility. It will be positive but declining in the beginning. Then at one level, it will be 0. After reaching 0, it will become negative. Okay, these are the three possibilities for marginal utility. So when these things happen for marginal utility concept, what will happen to the total utility curve or else that a number? So when marginal utility is declining but positive in a diminishing rate, okay, total utility will increase. That one thing you have to. There are three stages. When marginal utility declines, total utility will increase at a diminishing rate because it is declining, right? So total utility will increase but at a diminishing rate. Okay, so when marginal utility is 0, total utility will be maximum. That will be the maximum point, saturation point. Okay, so when marginal utility is negative, total utility will decline. Okay, these are the three stages of this relationship between marginal utility and total utility. So you have to remember that from that area only question will come from this concept. So these are the basic assumptions of marginal utility. Why I have given us, if you are reading only, you can understand what are these assumptions, because this concept, this chapter, this area is little easy for all the students, commerce or management, whoever it is easy. Okay. So assumptions of utility analysis, the first one is maximization of satisfaction. So every consumer, why we are buying, paying price, it is to maximize our utility level or satisfaction level. Rationality. Rationality means before buying, making a decision, okay, definitely you will compare the price and the product, whether it is worth to pay this much price for this product. So sometimes we like the product, but we don't think that product deserves this much price, and you won't buy that. Okay, that there comes pricing decision, wrong price for a product. Then later on, when it became a stock, then they will decrease the price because they know it is not giving the that much satisfaction as they expected, and they will decline the price. So rationality means comparing the price with the product and making a decision. Everyone logically we used to do that. What is the third one? Limited money income. Because always we want to get maximum satisfaction, which is stopping us from reaching that stage, our income level. Okay, so if your income is less, then the satisfaction you derive out of the consumption will be less. So if you are a rich person, then you can consume more better product and the satisfaction level will be very high. So limited money income, that's what restricting us from reaching higher satisfaction level. And next one, utility is cordially measurable. That you have to assume because we are studying the cardinal utility analysis. And next one, diminishing marginal utility. As I said, from the initial utility level, it keep on declining. Marginal utility will decline. It will never increase. Or in the first consumption only, it will be maximum. Marginal utility will be maximum at the first unit. Okay, so diminishing marginal utility, constant marginal utility of money. So this concept is very important in the assumptions of utility analysis, because one question is there, you will see that at that time you can answer it if you understood this concept. What is constant marginal utility? Why you have to assume it is, a thing is, in utility analysis, what you are studying based on the satisfaction level consumer is consuming the product. And one more thing is strongly connected with this concept, that is price. Okay, so for example, you are paying a price, you are getting some product, and from that product you are getting some satisfaction level, utility. So there are three variables. The middle one is the number of units you are consuming. The last one is the utility you derive from the consumption. So in utility analysis, we will be giving importance to the last two variables, not the price. The price will come under demand analysis. Okay, so you will study based on the satisfaction level, this many units are consumed. When the satisfaction level declines, the consumption level will also decline. So last two variable only you are studying. but strongly it is connected with what? Price. Price means what? Money. Okay. So when you are again joining this money, another concept, variable, important variable, measuring these two variables will be different. Okay. So that's why throughout the utility analysis, you are assuming the utility level of money is constant, because when this changes, measuring the changes in the other two variables will become a problem. It will be little difficult. So actually it is unrealistic, but still for analysis basic, if you want to do that, then you have to assume that constant marginal utility of money throughout utility analysis. It is not one thing you have to keep in mind is we used to get confused whether it is zero marginal utility of money or constant utility of money. It's not zero. Okay. So from the beginning, what is the utility of money in the first unit of consumption? The same utility till the end. That is the idea. It's not zero, it is constant. There is a very big difference between zero marginal utility of money. It will never be zero. It is constant. Then last one is utility is additive. That means you can add. That's why in total utility concept, you are adding the utility you derive from all the 5 units. Okay. So these are the basic assumptions. Here I emphasize you have to give more importance to constant marginal utility of money. It is constant, not zero. So under utility analysis, you will study these two concepts. I'm not going to elaborate it, but one thing you have to give importance is in utility analysis, mostly Marshall name is connected with these two analysis. But actually it was introduced by Gosen. That's why we used to call that as first law of Gosen and second law of H. Gosen. Okay, but it was developed and popularized by Alfred Marshall. So that's why mostly we will connect the utility concept with Marshall. So when a question is asked, then you have to see the part whether it is developed or else introduced. If it is introduced, if both the names are there, then you have to write the answer as Gosen. If it is developed or popularized, then the answer is Alfred Marshall. So law of diminishing marginal utility, we all know. What you have studied under utility analysis only, there is a connection between total utility and marginal utility. Marginal utility keep on declining and again it reaches zero and it will become negative. When it is declining, total utility increases at a diminishing rate, then it will be maximum and then it will be declining. Okay, this is law of diminishing marginal utility, applies for most of the normal product. This is how a consumer satisfaction level will change. Okay, this is first thing. And next one is law of equimarginal utility. Not much difference. In law of diminishing marginal utility, you will study about one product, and law of equimarginal utility, you will study about more than one product. Okay, that is the difference. So the thing you have to focus here is how a consumer will distribute his money income between goods. So the utility derived from the last rupee spent on each good is equal. So why this is important, what you have to understand in this concept is because you are consuming two products, not one product. So you have to distribute your total income between these two products. How you will distribute this money income? Usually, the last unit spent on both the product should give him equal level of satisfaction, or else I'm spending, dividing, for example, my income is 20 rupees and I'm spending 5 rupees on one product, 15 rupees on another product. But the last rupee is giving more satisfaction for X product. What I will do, then I will withdraw the money from Y consumption. I will buy more Y product, right? Because Y product consumption is giving me more satisfaction. When I will stop this substitution, withdrawal and buying more, purchasing more of other product, when both the currency last unit spent on both the product gives me equal, then there is no point in substituting, because from both the product I'm getting equal satisfaction, right? So there is no superior inferior product here. So both are balanced. So at that point, I will stop my consumption, substitution, right? So that is what law of equimarginal utility. It is called Gaussian second law. Okay, so this is also another concept. If you are just going through the introduction part only, I have said. If you are going through, then you can understand. This is the diagram for law of diminishing marginal utility, which I have explained already. Total utility increasing, reaching saturation, and it is declining. Marginal utility keeps on declining from the initial utility. Okay, so this part is also very important in utility analysis application part, because what we have learned in utility analysis is this law of diminishing marginal utility and equimarginal utility you can use for individual consumption. So where you can use it other than this consumption of mango, water, all those things. But it is a base for very big policies, public policies, taxation policy. So this is the basic foundation. Okay, so we will see where you can apply this concept law of diminishing marginal utility. So first one, in business everything is depends on what? Demand. So for demand, what is the basic law of diminishing marginal utility is the basic, that is the starting point. Okay, so derivation of consumer demand. In what way it is connected? A law of diminishing marginal utility is connected with consumer demand curve. Why they are not ready to pay high price for more commodity? Because uh, when I keep on consuming more and more commodity, it is giving me less satisfaction. So why I have to pay more price? What is the point in paying more price when it is giving me less satisfaction? Okay, so this is how the utility satisfaction level is connected with law of demand. So that is the first point. Taxation. Why we have to go for progressive taxation? Why you have to tax rich people and you have to spend on poor people? The logic is very simple. Law of diminishing marginal utility. In what way it is connected? What is the point in giving more and more money to the rich people? Because they are when they are getting more and more, they are not going to get any satisfaction from that. Utility level will be definitely, they will get some satisfaction, but it will be comparably less. And if you are giving the same money to the poor people, then the utility level or else satisfaction level will be high. So that is the reason behind the taxation policy. We are taxing the rich people, giving the money to the poor people, so that the satisfaction level of the nation will be high, the welfare of the country will be high. So ultimate aim of government is maximum welfare of the nation. So in that way, the law of diminishing marginal utility is connected with what? The taxation policy. Mostly the reason behind progressive taxation, or taxing rich and giving that to the poor people. And what is the next one is finance minister public economic policy. Public economics policy includes all taxation, public expenditure. Why you have to spend on poor people? Why you should not support the corporate or rich people? Because there is no point, it is going to give less satisfaction. That is the reason, public economic policies. And next one is diamond water paradox. So this is one of the complicated concept in economics, diamond water paradox, because most of the product which are very useful, people are not ready to pay more price for that. Okay, for example, water. The price is very less, but you cannot survive without water. And most of the necessary product, if you take, the price is very less, but the use is very high. So it has a very high value of use. But when it comes to exchange, the price, we are not ready to pay more price for that. But diamond, for example, the status symbol, okay, it doesn't have any use, but we are ready to pay high price. The value of exchange, means the price we are ready to pay for that product, it will be very high. Okay, so why this is coming? Okay, necessary product we are paying less, non-necessary comfort product or luxury product we are paying more. The exchange values are more, and for a necessary product the exchange value is less. To explain this also, the law of diminishing marginal utility concept is very helpful. Why we are paying less? It is available plenty, so obviously the satisfaction level, utility level will be very less. You are easily getting that, right? So the utility level will be very less. So we are not ready to pay high price. A diamond or all those commodities, no, they have a the production, there is a scarcity in production, so it is not available in plenty. So here the exchange value is very high. The satisfaction level you derive from that consumption will be very high, so exchange value is very high. So what is fixing this exchange value? Then the utility you derive from that product only, deciding the exchange value of a product in the market. So this is called diamond water. Why the price for water is less and why the price for diamond is more. Okay. So for explain that, this is helpful. Then consumer surplus concept, everyone would have studied that. In what way law of diminishing marginal utility is helpful in explaining consumer surplus? Consumer surplus is nothing but the difference between what? The willingness to pay price and the actual price. So what is a willingness to pay price? When the willingness to pay price will be high, when the utility level is high, the satisfaction level is high, the willingness to pay price will be high. If the utility level is less, then the willingness to pay price will be less. Okay. So to explain this concept also, this law of diminishing marginal utility will be very helpful. So these are the areas where you can apply the utility concept. Then next one is this ordinal indifference curve concept. Under ordinal indifference curve concept, you will be studying the meaning, properties, marginal rate of substitution concept, and you should know that is diminishing marginal rate of substitution, budget line, and how this budget line will change, and then this consumer equilibrium point. So all these things you have to cover under this ordinal utility analysis. We will just start with the introduction part of indifference curve. Indifference curve is nothing but a tool used to support the analysis of this ordinal utility. So what is indifference curve? An indifference curve is the locus of different combination of two commodities giving the same level of satisfaction. So this is indifference curve. So consumer is not fine with one combination. He is okay with indifference between different combination, 4 or 5 combination. So if you are plotting all the combination together in a graph, and if you are drawing a line, then you will get indifference curve. Okay, so indifference curve and is a combination of points which gives him equal level of satisfaction. So indifference curve analysis is based on these assumptions. But in this, from where you will get question means rationality, I'm not going to explain. We know what is rationality. Ordinal utility also, he cannot measure it, he can rank it. Okay, so there is a scale of preference. So first importance is given to this combination, second preference is given to the second combination. So like that he can rank. So that is a second assumption. Transitivity. Transitivity connected to this this assumption is actually very important. From this area they will ask question. So what you have to understand this: if a consumer prefer a combination of A instead of B, so his higher preference is what? A combination A, and he is preferring combination C to B, then definitely he will prefer the combination of A than C. Okay, so in this way you are going to rank it. Okay, so this is called what? Transitivity. If a consumer is preferring A to B, B to C, so definitely he will prefer A to C also. Again, if he is preferring C to D, then he will prefer A to D also. In that way you can connect, you can rank. There is a higher order and lower order of preference. This concept is called what? Transitivity concept. Consistency of choice. That is the next assumption. What is this consistency of choice means? Nothing but if I'm preferring this combination, next time also I will prefer combination. I won't change often. If you are not assuming this, then you cannot analyze this concept. Okay. Non-satiety means he is not satisfied with the current level of satisfaction. He will always try to reach the higher level of satisfaction, and that is called non-satiety point. Okay, and last one, diminishing marginal rate of substitution, because he is going to substitute one commodity for another commodity. So but it keeps on diminishing marginal rate of substitution. So these are the assumptions you have to keep in mind when you're studying the indifference curve analysis concept. Give more importance to the last four assumptions. What is transitive? A to B, B to C. Consistency, is not going to change it. Non-satiety, he is not going to satisfy with that, with his current level of satisfaction. Always try to reach the higher order satisfaction. And diminishing marginal rate of substitution is the reason behind the shape of the indifference curve. So apart from that assumption, you should know about the properties of indifference curve. These are the major properties. There are around 10 properties. I have given only 4. Why it should not be vertical line, why it should not be horizontal line, why it should not be convex in shape. So all these comes under what? This indifference curve property. There is a reason, strong reason behind that, why the indifference curve should not take other shape than convex shape. Okay, so first property, indifference curve slope downwards to the right. So that is the reason when you are studying this marginal utility, everything it starts from the higher order to the lower order. And indifference curve is convex to the origin. What is the reason behind that? Reason is diminishing marginal rate of substitution. If it is increasing rate of substitution, then it will be concave to the axis. So indifference curve are convex to the order because it is diminishing rate of substitution. It should not intersect or tangent with each other. And the last point is a higher indifference curve represents a higher level of satisfaction. So there is an order. So these are the basic properties of indifference curve. Marginal rate of substitution, I have already said what is marginal rate of substitution. So the rate at which one commodity is substituted for another commodity, that is what a marginal rate of substitution. So budget line, what is so if we are trying to study the behavior of consumer. Okay, so indifference curve help you to study what means which indifference curve is going to give you higher level of satisfaction. So in the assumption only we have said he will always try to move to the higher indifference curve, but which is going to stop him? The income level is going to stop him from moving to the moving from lower indifference curve to the higher indifference curve. So the income level you can draw with the help of budget line. To draw budget line, you need 3 variables: the price of X commodity, the price of Y commodity, and the income of the people. With the 3 variables, you can draw the budget line. Okay, I'm just giving you the introduction. Later we will go to the important part of the concept. Okay, so how the budget line will change? So there are 2 possibilities. When the price is changing, then the budget line will change. And when the consumer income is changing, then also the budget line will change. How it will change? It is shown in the diagram. If you are seeing the diagram, there are 2 goods, a good Y and good X. Okay, so here when the price of X commodity is changing, okay, when the price increases, what will happen to the budget line? When price increases, the number of unit you can consume, that will be less. So budget line will shift inwards. When the price is decreasing, then you can consume more. So budget line will shift outwards to the right side of the previous budget line. So this is the relationship between price and when change in income, you will be increasing the consumption of both X and Y commodity. So the budget line will move parallel to the previous budget line. This is how the budget line will shift. So there are two possibilities. When price is changing, budget line will change. When income is changing also, budget line will change. And why we are studying budget line and indifference curve? Ultimately, we are joining that together and trying to find out how the consumer will select his equilibrium point. So this is the point, consumer optimization or equilibrium point. There are two conditions for consumer equilibrium. One condition is the indifference curve which we are drawing in the diagram should be convex to the origin. That portion only will be the equilibrium point. The second condition is the budget line will be tangent to the the indifference curve. So these are the two conditions. One is it should be convex to the origin, and second point is it should be tangent to the indifference curve. So if a point is fulfilling these two conditions, then that will be the equilibrium point. So here consumer wants to move to the higher indifference curve, but he cannot move to the higher indifference curve because his budget line, his income is not allowing him to move to the consumer in higher indifference curve. He can choose any point between this triangle BOL, but he is choosing this E point because at this point only indifference curve is tangent toward the budget line. So this is how this is the reason behind studying the entire indifference curve concept and budget line. Ultimately, we are going to combine it together and finding what will be the equilibrium point of consumer. So this is indifference curve analysis, and in this you have to be a little specific about one more concept, that is price effect, income effect and substitution effect. From this area also you will get more questions. What is price effect? We all know when price increases, it is going to affect the quantity demanded. So that is called price effect. This price effect only going to decide the income effect and substitution effect. This price effect is going to be divided into income effect. Sometimes 45, the price change in price is happening because of 40% change in the income and 60% change in the substitution effect. So you can divide the total price effect into income effect and substitution effect. When I'm explaining the question, you will understand what is the importance of this price effect, income effect and substitution effect. Income effect is nothing but increase in real income due to increase in price level. What is substitution effect? Substitute cheaper goods for relatively higher goods. When price changes, all these things will change. Based on that, they will make the decision. Okay. So this is first question. You can actually answer. Cardinal utility analysis to consumer equilibrium was developed by. As I said, you have to see whether it is developed by or else introduced by, all those things. By saying that only you can answer. If it is introduced by, the answer is different, and here it is developed by, so the answer is Marshall. He only developed, popularized the concept. So it is not Gosel, it is Marshall. That is the answer for first question. So what is the second answer? Question is total utility curve always rises, first falls, then rises, always falls, first rises and then falls after reaching its maximum. So what is the answer? Total utility curve, it depends on marginal utility. So what is the answer means? You can answer if you understood the concept. You might have answered this like D is the answer. First rises, then falls after reaching the maximum level. When it will reach the maximum level? When the marginal utility is 0, total utility is maximum. When marginal utility is declining, again it is declining. Okay. So answer is D. And what is the next question? On this you can answer because already I told total utility is maximum when marginal utility is 0, marginal utility is maximum, marginal utility is increasing, average utility is maximum. What is the answer? Total utility is maximum when marginal utility is 0. Then at that time only total utility is maximum. And what is this marginal cardinal utility? Cardinal utility analysis assumes what? So it assumes marginal utility of money is 0, marginal utility of money is decreasing, marginal utility of money is increasing, marginal utility of money is constant. So usually we will know that decreasing and increasing, it won't be correct. Okay. So either it is 0 or concept. There we will get a confusion. So in the explanation only I have said it is not 0. 0 is wrong. Always it will be positive. We will get some utility out of money, right? So marginal utility of money is constant. Then only you can measure the utility. That's why we are assuming that. So option answer, correct answer is B. Marginal utility of money is constant. And next one, from this area also you will get more question. Hicks-Allen indifference curve theory is based on weak ordering, strong ordering, constant ordering, multiple ordering. So this question I have taken from your previous year question paper. So what is this weak ordering, strong ordering, constant ordering and multiple ordering? No, if the question is coming for net exam, just think what you will answer. What will be your answer? So randomly, I'm just assuming the right answer actually is weak ordering. Okay. So indifference curve is based on weak ordering. So what is weak ordering? Okay, because the other questions are connected with this concept. What is weak ordering and strong ordering? Okay. So when we draw indifference curve, we are saying different combinations give equal level of satisfaction. The same indifference curve only. There will be combination A, combination B, C and D, and you will combine all the combination, you will draw a line and that will be indifference curve, right? Locus of all combination of commodities which gives equal level of satisfaction, which clearly shows he is not able to say that which combination is going to give him more satisfaction, whether A or B or C or D in the same indifference curve. He's not able to say that. He's telling that combination is also giving him same satisfaction. The D combination is also giving him same satisfaction. So that's why he's not able to reveal it clearly. So that is called what? Weak ordering. Okay. So if he is able to reveal his preference, this combination is better. A combination I like. I don't like B combination. So if he is able to differentiate the combination, then it is called what? Strong ordering. So which concept is connected with strong ordering is another theory is called, is there like indifference curve, revealed preference. He is able to reveal his preference in a strong way. So there is no two different combination which gives him equal level of satisfaction under revealed preference theory. Okay. So these three things you have to keep in mind. Cardinal utility analysis is separate. In ordinal utility, indifference curve analysis is based on an assumption of weak ordering. Weak ordering means is not able to say things clearly. Okay. And strong ordering is he is able to say things clearly. He is not indifferent. He is different between two products. And which theory is connected with that? Revealed preference theory is connected with that. Probably you would have studied at MCOM level. This revealed preference theory. Okay. So Hicks-Allen indifference curve theory. Right answer is it is based on weak ordering. And in case of a convex indifference curve, marginal rate of substitution is constant, marginal rate of substitution is increasing, marginal rate of substitution is negligible, marginal rate of substitution is diminishing. So what is the answer? The reason behind the convex shape is diminishing. If they have given concave, okay, so when it will become concave, then it is increasing marginal rate of substitution. Okay, so here the answer is D. That is the right answer. Here the next question is what is strong ordering means? Okay, so I said what is the meaning of strong ordering? Option A is what? Absence of indifference. Option B is presence of indifference. Option C is no difference between different combination. Option D is none of the above. So in indifference curve analysis, there is the presence of indifference. Okay, that means based on weak ordering. It is based on weak ordering. So strong ordering means absence of indifference. So there is no indifference. He is able to differentiate the product. First preference, second preference, like that. He is able to differentiate the combination. So the answer is A, absence of indifference. Okay. So under which concept the presence of indifference is there? Indifference curve analysis. Okay. So we will move to the next concept, demand analysis. So this is another important area. I'm just moving fast, otherwise we cannot cover. Okay. So here these are the areas you have to cover, focus. So what is the first? We know what is meaning. Demand function is very important. Under demand function, you will study the determinants of demand. Law of demand, we all know it shows the relationship between what price and demand, expansion, contraction, increase, decrease. This expansion, contraction, you have to give more importance. Increase and decrease, you have to give more importance. I will tell you what sort of questions are there in your previous year question paper. Then types of demand we can study. Reason for the downward sloping demand curve, exception of demand. So these are the major areas you have to cover for net exam under demand analysis concept. So I am not going to tell what is demand. We all know if a person usually it is a desire for a commodity, but in economics, if it is accompanying by ability and willingness, we used to call that as what? Demand. Because if he is not ready to pay the price, if he doesn't have that much of money, then there is no point in considering him as our consumer. So we are not producing a product for him. Okay, so we will completely ignore him. So that is a demand for. So there are a lot of determinants we have studied. Okay, so roughly price is the primary determinant of a demand. Depends on price only. The demand of the commodity will change. And other than this price, there are a lot of other commodities. So this concept is very, very important from net exam point of view. So I will tell how it is very important, what kind of questions are coming from this area. Okay, it looks very simple, but you should know the determinants of demand. Other than price, I have say, for example, income level of the consumer. When income increases, what will happen? The demand will increase. Population, taste and preferences. So all these things you have studied as what? Determinant of demand. Okay, so now we are applying that determinant into the concept and the question usually they are asking for net exam. See here, see the first concept is expansion and contraction of demand. What kind of question is coming from this is, so they will ask when this is happening, they will give you a situation, they will ask you when this is happening, how the demand curve will shift, whether it will shift to the right side or left side or downwards or upwards. So these sort of questions are coming. Okay, so you must understand the basic if you want to answer such question. So if you have attended net exam before, definitely you would have seen at least one question from this area, how the curves will shift, right side, left side, down, up, all those things. Okay, so now I will tell you very simple logic only it is. The expansion and contraction means usually this term we will use only for the changes in price. We won't use for the other factors, external factors. Price is an internal factor, okay, which you can adjust. Price is fixed by who? The firm. Income level, population, taste and preference, everything is external factor which you cannot influence. Based on that, you will adjust your demand. So that is the major difference between the determinants of demand. That difference you should know. When the internal factor changes, that is when the price changes, so the shift will be on the same demand curve. Okay, when price decreases, the demand we will move to the higher portion of the demand curve. When the price decreases, when the price decreases, we will go to the higher portion. When the price increases, we will move towards the lower portion of the demand curve. This process is called expansion and contraction of demand. Internal factor, price is changing, so the movement will be on the same demand curve. It won't shift to the right side or else left side or downwards or else upwards. Okay, same demand curve. So this point you have to keep in mind. And I'm coming to the other determinants. Other than price, if there is a change in other factors, population is changing, taste and preference is changing, income level of the consumer is changing, then the demand curve will shift. It is not expansion or contraction, it is shifting, changing. Okay, so how it will shift? Whenever population is increasing, okay, it will shift to the right side. So whenever the quantity demanded is increasing, the demand curve will shift to the right side. Whenever it is decreasing, it will shift to the left side. So this one point you have to remember. So increase can be only shown to the right side shift of any curve, because if you see the horizontal axis, so how it is shown? OQ quantity, then OQ1 quantity, right? So the right side is what if you want to show any increase, you can show only on the right side of the previous quantity. If you want to say that the quantity is increasing, then the quantity is increasing from OQ1 to OQ2. So some point here, okay, to the right side of the Q1. So where you have to draw the line, to the right side of the previous line only you can draw. Okay. So why this point is very important means it will be little confusing. When in demand you will be asking, okay, if they are telling it is right side, if the answer is given there as right side, then obviously you will write it's right side. So there is no right side answer, okay. They have given it is, there is a downward shift or else upward shift. Then how you will identify, okay. So there is no right side shifting or else left side shifting. The answer in the question paper is whether it is downwards or upward, okay, inward or outward, like that if they have asked. Then you have to always think which curve. So listen, for all the downward sloping curve, right side shift will be an upward shift. So here, for all the upwards sloping curve, right side slope shifting will be to the left side. Okay. For example, for demand curve, right side. So upward shifting. For supply curve, it is an upward sloping curve. So what will happen? Right side will come below to the previous supply line. So that area you have to be very clear. The constant thing is always it will be right side shift for increase, left side shift to the decrease. But what is the differences for a downward sloping curve like demand curve? Right side shifting means what? It is an upward shifting. For an upward sloping curve like supply curve, right side shifting is what? Downward shifting. So that area you just look into that and make yourself clear that how the shifting will happen. Okay. So for example, here this is the supply curve. So how it is shifting? For example, increase. It is an increase. So you have to draw to, as I said, to draw a shift in the increase in supply, you have to draw a line to the right side of the previous supply line. So SS is the supply line, original supply line. Now the supply is increasing from 0.5 to 0.8. Okay. So to show this 5 to 8 increase, I have drawn a new supply line to the right side of the previous supply line. But if the question is it is a downward slope, it has shifted to downwards or what? Upwards or else inward or outward. This is what? Outward shifting to the lower portion of the previous supply line. Here again, here there is a decline in the supply curve. If it is right or left, declining always will be there in the left side of the previous supply line. But it is an inward shifting of curve, or it has shifted to the, it is an upward slipping to the previous, if you take the previous supply line, it is SS. Now it has sloped to the um, high level of the previous one. Okay, so this is how the curve will shift. You have to decide which one is correct, right, left, down, and up. That you have to see. And that is one area you have to check. And the next one is exception of law of demand. What is exception of law of demand is, these are the areas you have to cover. Snow puppy or Veblen goods, and inferior goods, they are again what? The exception of law of demand. Given goods are exception to the law of demand, and demonstration effect and possibility of future prices, rise in prices, fear of shortage, and ignorance. So these are few areas which we are considering that is an exception of law of demand. That means when price increases, the quantity demanded also increases instead of declining. Okay. So this is exception of law of demand. I'll just tell what is what. So snob appeal or Veblen goods means auspicious consumption, luxury goods will fall under that category. So if the price is high, the demand will high. If the price is less, there won't be any demand because they are considered as a status symbol. Okay. So that is first commodity, Veblen goods. And the second one is different goods or inferior goods. Little confusion will be there in this category. You have to be more careful. What is this inferior goods and what is given goods? What is the difference between these two commodity? Because they used to tell that all given goods are inferior goods, but not all inferior goods are given goods. Okay, so what makes this difference? So previously we have studied three effect, price effect. This price effect is divided into what? Substitution and income effect. In terms, when it comes to inferior goods and given goods, if you see, the income effect is positive. Okay, so when income effect is negative. What is negative means? When income increases. Okay, for example, in case of this inferior goods, for example, when income increases, what will happen? The demand of the product should increase. But what is happening is, when income increases, the demand of the commodity is declining. For example, you can take the example of second-hand car. Okay, so when when your income increases and you are having a second-hand car, and what you will do, you won't buy one more second-hand car. But what you will do, you will go for a new brand car, right? We will go for a new car. So here it is not applying the income effect. It is not working there. Why it is not working here means, the concept which we are relating here is substitution effect, because for this inferior goods there is a strong substitute. So for second hand car, what is the substitute? New branded car is a substitute. So when my income increases, instead of buying one more, I'm going for a new one. What is given goods is, here also the logic is same. What is happening is, when price increases, no, the demand will also increases. It is not declining in case of given goods. So the example is stable goods. For stable foods, all those things falls under that category. Rice, in North India it is wheat. All these things comes under what? This different goods. So when the prices of these commodities increases, instead of decreasing the quantity demanded, what we used to do is, we will decrease the consumption of other commodity and we will spend the money in this commodity. So here the demand is unaffected. It is not declining. Okay. So that is given goods, rice, wheat, everything. What is the reason behind that? These commodities are not having any close substitute. So you cannot find a substitute for what? rice or wheat. They are our major staple food commodities. Okay, so these are the example of what inferior. Here you have to see the income effect is less for inferior good. The income effect is less. The substitution effect will be more because there is a presence of substitute commodity. For given goods, what is happening is here the income effect will be less, income effect will be more, substitution effect will be less. Why substitution effect is less? There is no close substitution for given goods. Keep this example in mind. In inferior good, what is an example is second hand car. So you will be going for a new car, and given goods, the example is stable food, rice, wheat, all those things, no substitute. When the price increases, you will reduce the consumption of other product and you will be spending the money here. So the demand will remain unaffected. Okay. And demonstration effect, we all know what is the demonstration effect. By seeing others, we will buy the product. We won't see the price increase in price. It is a status symbol. My neighbor is buying, then I too have to buy that to maintain the status. So that is called what demonstration effect. And possibility of future rise in prices, fear of shortage, ignorance, all are considered as what? Exception, law of demand. Here what you have to focus is inferior good, given good and Veblen good. And in inferior good and given good, what you have to focus is income effect, price effect and substitution effect. Price effect remains same for both the commodity, but the other two effects are different for both the commodity. For inferior good, what you have to keep in mind is substitution effect will be high and income effect will be less. And for given goods, what you have to keep in mind is substitution effect is very less because there is no substitute, and income effect will be more. So these things, three effects you have to consider because they will ask question from that area also, area only. Okay. So we will just roughly gone through what are the exceptions, what is law of demand, all those things, how the demand change, how the curve will shift, all those things we have seen. This is elasticity of demand concept. What's the difference between this law of demand and elasticity of demand? From this area also you will get more question. So always we will get confused when they are giving some example. Okay. So elasticity of demand is nothing but in law of demand, you will study the relationship between price and demand. So you will see that there is a change in the quantity demanded when there is a change in price, but not to what extent it will affect the demand. That we won't study under law of demand. So in elasticity of demand, you will study when price change, to what extent it will affect the quantity demand. That is the difference between law of demand and elasticity of demand concept. Okay. So there are 5 changes broadly we are classifying. Okay. So for understanding purpose, when you are calculating that practically, you will get different numbers. So here degrees of elasticity, there are 5 different possibility. Elasticity of demand can be 1, or else it can be infinity, or else it can be greater than 1, lesser than 1. Okay, so in what case it will be? So we will just revise it. You you would have known that, but we will just see what it is. Okay, so if 20% change in price is bringing 20% change in quantity demanded in the same proportion, then it is what? Unitary elasticity of demand. Okay, in the same level it is changing. And what is this zero elasticity of demand is when 20% of change in price is not bringing any change in the quantity demanded. Okay, so 0% change in demand. So it is a vertical line. So they will give you the diagram and they will ask, or else they will ask you which diagram shows elasticity of demand is 0. Okay, so you must be clear. Just draw the diagram and see. Draw a vertical line and just check. Draw the 2 price line and check here. A1 also same quantity demanded. OQ is the quantity demanded at the price of A1, and the price is OA2, then again the quantity demand is same OQ. Okay, there is no change in the quantity demanded. It can be represented only through a vertical line. So elasticity of demand is zero when elasticity of demand curve is a vertical line. Okay, so it is infinitive when the line is horizontal. Okay, so what is infinitive? Even a small change in price will bring a greater change in the quantity demanded. That is called an infinitive change. Okay, so even a rumor is enough. So the price is going to change. Often happens with gold, all those things. Suddenly they are telling in another month the gold price is going to double. Whatever money we have, we will be investing on gold. Okay, so even a small change in price will bring a greater change in the quantity demanded. So it can be shown only through a horizontal line. Okay, so here price is actually not at all changing, a small minute negligible change. But how the quantity demanded is changing from OQ to OQ1. Okay, so this is horizontal line. So other than these three concepts, relative changes are there. What is relative? Even 20% of change in price is bringing 40% of change in quantity demanded. Okay, so then it is relatively elastic. A small change in price is bringing more than proportionate change in the quantity demanded. Okay, so that is relatively elastic. So relatively inelastic means what? 40% change in price is bringing 20% change in quantity demanded. I am changing the price to a larger proportion, but the quantity demanded is changing only to a smaller proportion. Okay, 40% change in price, 20% change in quantity demanded. So it is relatively inelastic. Less change means what? Inelastic. More change means more elastic. Okay. So there are five concepts: relatively elastic, relatively inelastic, unitary elastic, perfectively inelastic, and perfectively elastic. Five different concepts are there. It is based on the proportional change in the price and the quantity demanded. So you have to be little clear about the shape of the curve, because from here only the question will come. So whenever it is more horizontal, it is more elastic. Purely horizontal means what? Perfectively elastic. Little horizontal means what? Relatively elastic. If it is a straight line, okay, it is a perfectively inelastic. There is no change. And if it is steeper line, more or less a straight line, okay, then it is what? Relatively inelastic. Unitary elastic, I don't want to explain. You know, right? 20 percentage change and 20% change. Okay, so these are the concept. Here, next concept we will just go through is methods to measure what? This elasticity of demand. So there are four methods. Percentage method, if you want to study the percentage change in quantity demanded and price, then you have to use percentage method. So usually the formula we will use for elasticity of demand is a formula used to calculate the percentage method. Okay, so that is the first one. Second, point method. So this method, when we draw a demand uh, curve and you are trying to find out the elasticity of demand at one particular point in the demand line, then you can use what? Point method. So if you want to study the elasticity of demand at a particular point, means you can go for point method. Okay, there is a formula: lower segment divided by the upper segment. So if you are using that formula, then you can find out exactly what is the elasticity of demand at that particular point in the demand curve. And what is the next one? Geometric method, arc method. So it is little different from point method. In what way it is different means, if you want to study the elasticity of demand between 2 points, in a particular point means it is point method. Between 2 points, that means in an area, a particular area of a demand curve, then you can go for what? Geometric method. Okay, so this is also called arc method, flux method. So there are so many names for this method, and the last one is total outlay method, using the total expenditure of the firm. If you are trying to find out the elasticity of demand, then it is called what, total outlay or expenditure method. You just go through, you can understand it is very easily. The purpose and need of based on the need and purpose, we will be choosing which method you are going to adapt to calculate the elasticity of demand. So this is cost analysis. Whatever we have seen before, you will be much familiar about. Okay, utility and demand, it will be comparatively easy for commerce students. What we are going to see cost under this cost analysis and perfect competition is little complicated. So meaning of cost, types of cost, relationship between cost, meaning of revenue, types, relationship between AR and MR. All these things we are going to see. See, listen, if I'm briefing the introduction part on those things, then it takes time. We cannot finish. We cannot move to market structure concept. So I will just tell where you have to focus. Okay, from where I have seen more questions in Commerce Net question paper. That is all about the relationship between cost. In economics, we will be focusing only on three cost. One is total cost, that concept, average cost, and the next one is marginal cost concept. So total cost, when we are adding, we will get the total cost. We won't focus much on that. Whenever we draw a diagram, we will be using the average cost and marginal cost. So you should know the relationship between the marginal cost and average cost. What you should know is how this will change, how the average cost change when this marginal cost is changing. Okay, same concept only like what you have studied in marginal utility, the total utility. The marginal cost, no, that is the cost which decides the shape of the average cost curve. Okay, so how means keep this one point in your mind, whether it is a fall or rise, the marginal cost will be higher. Whether it is a fall or rise, the marginal cost will be higher. Okay, when average cost falls, marginal cost will fall more than the average cost. When average cost rise, marginal cost will rise more than the average cost. Okay, so if you see the diagram, ATC is the average cost. So here the concept is average cost is declining from here to here. Okay, it's declining, and how the marginal cost, it is coming lower to the average cost, and from one point after reaching the lowest point, average cost is increasing. How the marginal cost is increasing, it is increasing more than the average cost. So whether it is fall or rise, marginal cost will be dominating the average cost, it will be higher. Okay, so that is the relationship you have to keep in mind. Always marginal cost decides the shape of the average cost. So long run cost curve. So long run cost curve, if you are adding all the short run cost curve, you will get a long run cost curve. Okay, it is also called as envelope curve. All the concepts are there. So one question they can ask from long run cost curve is like what is the reason behind this shape, this envelope shape, this U shape. Okay, so here when the cost curve, long run cost curve is declining, okay, the reason behind this, the economies and diseconomies of scale. You would have studied that. What is this economies and diseconomies? That nothing but the advantages and disadvantages of producing more units. So scale means what? Producing at large scale. Okay, when you're producing more, you will be enjoying some advantages. There are some disadvantages also. So we are not going to get into that. I will just tell what is the reason behind the shape. In the beginning, it is a downward sloping the curve. Okay. So the reason behind the downward sloping is in the beginning, the economies of scale will be more than the diseconomies of scale. That means the advantages of production will be more than the disadvantages of production because of so many reasons, internal and external economies of scale you would have studied. Okay, so that will be advantages will be more. That's why your cost is declining, cost of production is declining. So till one point, the minimum level, it will decline. After some point, it will start to increase. So at that point, why it is increasing means the disadvantages are dominating the advantages. The disadvantages are more than the advantages. So that is the reason behind the increase in the cost curve. So in the same cost curve only, there are three areas. It is declining, and after it is reaching a lowest point, again it is increasing. The reason is why it is declining in the beginning. The advantages, economies of scales are more than the disadvantages, diseconomies of scale. Why it is increasing after the cost is increasing? That is not good for a production, right? Why it is increasing? Because the disadvantages are more than the advantages. That's the reason behind the shape of long run cost curve. So we will enter into this concept, market structure concept. So this concept is very important. More questions will come from this area only. So there are five: market structure, perfect competition, monopolistic, oligopoly, duopoly, and monopoly. Okay. So usually market we will classify based on different categories: local market, regional market, all those things. But here in economics, this classification is completely based on the competition level existing in the market. If the competition is very high, then it is perfect competition. If it is zero, then it is monopoly. And based on the level of competition, the in between categories are coming: monopolistic, oligopoly, duopoly, bilateral monopoly. All those things will come. Okay. So here the classification is purely based on the competition level existing in the market. So we will just see what is perfect competition, from what kind of question they are asking, and then we will go to the question. Then you will understand why I have said all those points. Okay. So what is perfect competition? We know the competition level is very high. That is perfect competition, and there are so many features: free entry, exit, so normal profit, and zero transport cost. These are the features of what? Perfect competition. So in perfect competition, before studying this market structure, two things you have to remember. Then only you can understand that clearly. What are the two things is, only two things we are going to see in this. This market structure completely comes under the pricing strategy concept of business economics. Okay, what is this pricing strategy policy? How this market structure concept will support this pricing policies means, listen, when the competition is very high, based on that only you can decide the price. When the competition is less or zero, like monopoly, you can go for any price. Your pricing policy will be like what? It's very easy to fix the price because there is no competition. Whatever price you have fixed, they have to buy your product. Okay, so this falls under the pricing policy. In this chapter falls under what? The pricing policy concept. So listen, two things we are going to do in this concept. One is you are going to decide the price and output of the firm. That's why it is called price output determination under perfect competition, price output determination under monopoly, monopolistic, whatever it is. Okay. Second thing, the most important part, after deciding the price and output of the firm, you should know what is the profit and loss. So two things only we are going to do. Okay. One is you are going to determine the price and output. Second thing, at that particular price and output, what is the profit and loss for the firm. So why I just I'm telling this point is, for deciding the price and output, you need two curves. Okay, what is that is MC and MR. With the help of MC and MR, you can find out which is going to be your price and what will be the output. And the other two curves you are going to use is AC and AR. So with these two curves, you can find out whether it is a profit or loss. So MCMR to find out the price and ARAC to find out whether it is profit or loss. So here if you see, there are diagrams given. These diagrams comes under perfect competition market structure. So if you see the condition equilibrium point of the firm is E1. So why it is E1? To find out the price and output, there are two conditions. MC is equal, should be equal to MR. Second is MC curve should cut the MR curve from below. These are the two conditions. If a point satisfies these two conditions, then that will be the equilibrium point. So here if you see E1, at this point MC curve is equal to, it is intersecting the MR curve. So it is MC equal to MR, that condition is fulfilled. Second thing is MC curve is intersecting the MR curve from below. So it is satisfying both the conditions. So this is the equilibrium point, this is the price, and this much output only we are going to produce. So after fixing the price and output, now the point is whether it is a profit or loss for the firm. Okay. So for that you have to check the AC and AR curve. So AC AR curve is a straight line, AC curve is a U-shaped curve. Okay, if you see the difference is what? Here AC curve is below the AR curve. So cost is less than the revenue means then definitely it is a profit for the firm. So here in the first diagram it is a profit. Here AC is on the intersecting the AR curve. So it is normal profit. There is no gap between the AC and AR curve. And here AC curve is above the AR curve. That means cost is higher than the revenue. So cost is higher than the revenue means definitely it is a loss for the firm. So always there is three possibilities. There can be loss, there can be profit, or else there can be normal profit. So that can be decided by the gap between the AC and AR curve. If cost is more, then it is what? It is a loss. If cost is coming below the revenue curve, then it is a profit for the firm. So these are the three different conditions. In perfect competition, usually in long run, always there will be normal profit because of high level of competition. And one more point you have to notice in this perfect competition is the demand line will be a straight line. AR line only, demand line. Okay, wherever you see AR line, you can fix that. That's the demand line for the firm. So here AR line, MR line is a straight line. That means demand line is a straight line. And after that, you are drawing the cost line, MC and AC. And the next market structure is monopolistic competition. I will tell how it is different from perfect competition. More or less, the features of perfect competition and monopolistic competition are same. And what is the difference is the demand line. AR and MR line is different. Okay. So if you see, both are downward sloping curve. In perfect competition, it is a straight line. AR and MR is a straight line because of why it is a straight line? When the demand is perfectly elastic, in the elasticity of demand, you have studied that it is a horizontal line. When the elasticity of demand is infinity, then it is horizontal, perfectly elastic. Okay, so that's why in perfect competition it is high level of competition, demand is perfectly elastic. So you have drawn the AR line as a straight line. Here in monopolistic competition it is relatively elastic. Okay, competition is there, but still what is their brand name, all those things comes under what? Monopolistic competition. Most of the commodities will comes under what? This monopolistic competition, hotel sector, everything, because they all involve in same business. There is a product differentiation, and advertisement cost will be very high in what? monopolistic competition, because you have to prove your consumer that your product is different from your competitor product. So to some extent the prices also different for all the product which are there in the monopolistic competition. So this is how monopolistic competition is different from perfect competition. Okay, the example of perfect competition is what? Agricultural product, all those things will come under what? This perfect competition, because there is no product differentiation. 1 kg you are buying from rice, you are buying from one shop will be same as the same 1 kg rice you are buying from the other shop. Vegetables, fruits, there is no difference. Okay, but here in monopolistic competition, soap, all those things, there is a product differentiation by flavor, color, size. You can prove that the product is different, so that the price line, the demand line, that is also different for monopolistic competition. Cost line will be same for all the market structure, whether it is perfect competition, monopolistic, monopoly, whatever it is, there you won't see much change in the cost line. Okay, so it is relatively elastic. So in short run, there is a possibility of three. Sometimes there will be normal profit. When there is a normal profit, you know, if AC is equal to AR, okay, if it, both are in the same line, same point, then it is normal profit. If average cost is more than average revenue, then it is a loss, because cost is more, revenue is less. Okay, and if average revenue is more than average cost, then it is a profit, because revenue is more than the cost. So to find out whether it is profit or loss, you are going to use only two curves, that is AR and AC curves. So here you can see all the three are possible in monopolistic competition at short run, but in long run, I will just explain monopoly, then I will tell what is the difference between monopoly and monopolistic. For monopoly and monopolistic, more or less everything is same diagram. For short run, there is no difference. Okay, same diagram only you will see. And what is the difference between monopolistic and monopoly market structure is, again, the demand line is a little different. Okay, so it is what? There you have seen, right, in monopolistic competition it will be little more horizontal. It is relatively elastic. Monopolistic, relatively elastic means competitors are there, but in monopoly there is no competitors. Okay, so that's why it is less elastic compared to what? Monopoly, there is no competitor means whatever price I fix, they have to buy my product. So it will be from that logic only you can understand it is less elastic. So monopoly, it is less elastic AR curve. Keep in mind that is the only difference between monopolistic and monopoly market structure. The demand curve is different. For monopolistic it is more elastic. For monopoly it is less elastic, because there is no competition. The complete market structure is based on what? The competition level. Okay, so again the second difference, other than this revenue curve, the second difference between the monopoly and monopolistic market structure, it is very, very important. What is the second difference between this monopoly and monopolistic is the long run diagram. So in long run, what will happen means, for monopolistic, always normal profit. For monopoly, it is always it is abnormal profit. That is the difference between monopoly and monopolistic. Why there is normal profit for monopolistic and abnormal profit for monopoly? Again, competition level. Okay, in monopolistic market structure, there is competition. So if they are earning more profit, what will happen? It will attract more producers into the market structure. So more people will enter into the industry. They will start producing the commodity. So ultimately, these people profit will come down in long run, and everyone who are in the monopolistic market structure, they will be earning normal profit. Here, what will happen in monopoly? In short run, if in the beginning stage there is a possibility for loss, sometimes they will get a normal profit, sometimes it will be abnormal profit. But long run, since there is no competition for them, always they will adjust the pricing policy, their output policy, everything, and they will maintain abnormal profit monopoly. So this is possible in monopoly, not possible with monopolistic. Okay. So please note down only two changes. One is the revenue curve, that is more elastic for monopolistic, less elastic for what? Monopoly, because of the competition level. And again, the second difference between the monopoly and monopolistic also very important. That will happen in long run. In long run, monopolistic firm will earn only normal profit, always AC equal to AR, but monopoly will earn abnormal profit. The average revenue will be more than the average cost. Okay, so this is the major difference. This oligopoly, with this we will finish. Okay, so oligopoly is also very important. It is also called Swiss model of king demand curve. So all this name, the economists name the king demand curve, all the concept is connected with the oligopoly market structure. Okay, so when we say the competition level is very high for perfect competition market structure and monopolistic, the competition level you used to see in oligopoly is completely different. Cutthroat competition, very high level of competition, because it is considered as competition between few. Five big firms will be there and they will be competing. So the market share will be high for all the five firms. So when big people compete with each other, the competition level will be very high. So the person have to watch the other person keenly, what kind of policy he is framing. According to that, he will frame his policy. So they will be actively seeing the policy of the competitor firm. Okay, that is the difference. High level cutthroat competition in oligopoly. It is not less. It is very like what high level keen competition. Okay, not like monopolistic, all those things. But this concept is very important. What makes the oligopoly market structure very special, peculiar, is the demand line you are seeing in the diagram. So in a demand line, as I said, it is nothing but the AR line, average revenue line, you have seen in the previous diagram. That is only demand line. Okay, so here it is given as demand line only, not as average revenue line. You can also call that as average revenue line. So it is not a straight line. In all the other diagram, it can be horizontal, it can be steeper, or else it can be narrow, but it is a straight line. Here it is not like a straight line. Till one portion, it is more horizontal. After that, it is becoming little steeper. So there are two different portions in what? The oligopoly market structure, which means there is a king in between, a bend in between the demand curve. So what is the reason behind that? You should understand to answer this question. Okay, so what will happen means, since there is a cutthroat competition, when a firm increases the price, okay, no one will increase the price. They won't follow the firm which has increased the price. So usually the firm intention for increasing the prices to earn more profit. They are producing same product. Example is petroleum product, cement industry. All those things falls under what? Oligopoly market structure. There is no much difference in the product. Okay, so here the point is like when they are increasing the price, no one will increase the price. So what will do? The consumer will do, since this firm has increased the price, they will move to the competitor's commodity. So it is inelastic. His intention is not happening. Okay. So next, but when the firm is decreasing the price, thinking that if he is decreasing the price, the quantity demand will increase. That will never happen, because when this firm decreases the price, his competitor will also decreases their price. So same consumer base will be there. So there is no much increase in the quantity demanded. So why the shape is coming is, above the point P, the demand curve is inelastic, because when it increasing the price, okay, so it is not affecting. And when the demand curve is below this point P, PD demand curve, this line is more elastic. because sorry sir, when it is increasing the decreasing the price, all the firms are doing decreasing the price. So what it is happening, it is becoming more elastic, so easily it will lose its demand. So even a small change in PD is inelastic and KP, you just keep in mind it is elastic. Okay, so this is the reason behind what king demand curve. There is a king when the person is increasing price, no one are increasing the price. It is inelastic. When price is keeps declining the price, everyone are declining the price. Okay, so this is the reason KP elastic and PD is inelastic. KP is more elastic, PD is less elastic. Okay, that is the concept you have to keep in mind. It is called king demand curve, and the person connected to it is Vesi, the economist, one of the famous economists. And we will see a few questions from this chapter and we will finish it. And if there are many firms in an industry producing goods that are similar but slightly different, this is an example of what? So many firms are there. They are producing more or less similar product but slightly different. So it is monopolistic market structure. And what is the next question? A monopolistically competitive firm can raise its price somewhat without fear of pay change in units, because there is an answer is brand loyalty is the answer. Okay, so that is only going to keep the consumers with them. And this is also taken from previous year question paper. In a perfectly competitive market, a firm long run operates the level. So in perfect competition, everything in long run, average cost will be equal to average revenue, marginal cost will be equal to marginal revenue, and all the four will be equal. So the answer is D, AR equal to MR equal to AC equal to MC. Okay, and the king demand curve of oligopoly is developed by the economist. So we see that is the answer. And the next question I have seen in your question paper is the demand curve facing a perfectively competition, whether it is a upward sloping, downward sloping, horizontal or vertical. In perfect competition, it is a horizontal line. So because it is perfectively elastic. And firm and perfect competition face what kind of demand curve? So it is a perfectly elastic demand curve. So it is not inelastic horizontal line. Okay, so that is the answer. Option A is the answer. And so these are few questions. These kind of questions will come for exam from this chapter, but you have to go in depth. You have to be little strong in the foundation also. How you can prepare is identify the area and give more importance. Give more importance to elasticity concept and this market structure unit. In 2 hours, it's very difficult to cover in depth. I have just revised the introduction part. With this you are reading, then you can understand. So please focus on the major area, not everything. Okay, okay, with that we will finish the class. So I will send you the PPT and a complete detailed notes also there in Word format. Both the things I will send it to your mail. Okay, thank you.
Hello, Vinodha ma'am.
Yes, sir. I can leave now.
Yeah, yes, ma'am. I already informed this admin to end the session. I think they are not in the seat. You can leave, ma'am. No problem.
ಎಂಡೇ ಮಾಡಿದ ಸೆಷನ್ ಎಲ್ಲಿರ್ತೀರಪ್ಪ ನೀವು ಗುರು? ಅಮೀರ್ KJC